Hello and welcome to my Invest Engine portfolio update for February 2025. In this video, I'll take you through my stocks and shares ISA and self-invested personal pension. And what a month it has been for the markets. I'm not going to go through all the market news again though, because I did cover it in the Trading 212 update. But basically in this video, I want to show you how it's impacted my portfolio, what I've done, and also the significant contributions I've made this month, especially in my self-invested personal pension. I'll take you through the reasons why and what my thoughts are going forward. Here we are in my Invest Engine account. You can see the total balance is now £34,798.95. So it is up from last month, but this is due to contributions on my part, definitely not because of market performance. And then the next thing to notice here is remaining allowance, 20,993. Now, to quickly explain this again, this is because Invest Engine is now a flexible ISA, and at the start of the tax year, I withdrew about £4,500 from a money market fund that I had for a short-term goal, and that 4.5k got added to my allowance. That is why my allowance is above 20k. However, I then have to take off my contributions to my stocks and shares ISA on Trading 212 and Hargreaves Lansdown for my lifetime ISA. So when you take them into account, my actual allowance remaining is about 3,400 odd. I'll put it on screen exactly what it is. I'm probably not going to be able to max out the ISA this tax year though, because I have chosen to prioritize my pension in this last couple of months, but I'll go through that in more detail when we move on to the SIP. So jumping into the ISA now, you can see my investment return now stands at plus 4,253, rate of return 28.65%. Switching to the 1 month view though, we can see over the past month it's down by £902, so it really hasn't been a good month, minus 3.5%. And you can see here on the 27th of February, I added £200 plus a small bit of change. I think that change is coming from the dividend that I received this month from UC99 at £7.50. So switching back to investment returns, scrolling down, we can see how the ETFs have performed over the past month. So first up, we have XDEQ, the MSCI World Quality ETF. So I'll just click on this. I thought it'd be interesting to share a bit more detail about these ETFs. So scrolling down, we can see here Invest Engine tells us this ETF provides exposure to global companies that are considered to have high quality characteristics. Now, an important thing to consider about this ETF is that it doesn't track the main MSCI World Quality Index, it tracks the sector neutral index, which basically means the sector breakdown doesn't differ too much from the standard MSCI World. The total expense ratio is 0.25%, so you are paying a little bit more for that factor tilt than a standard market cap weighted fund, and it is a very large fund, 1.3 billion fund size, and physical full replication. And that is down by 3.38% over the past month. We then have GGRG. This is another quality factor ETF, but it does work differently. If we click into this one, scroll down, we can see it aims to invest in companies with high quality characteristics and the potential for strong dividend growth. A bit more detail here, it only includes dividend paying quality companies and it is weighted by total dividends paid rather than market cap. But if we scroll down, we can see the consequence of the dividend weighting and only including dividend paying companies. It is quite different from a standard global fund. You've got Microsoft and Apple at the top because although they have a relatively small dividend yield, 1% of a multi-trillion-dollar company is still a lot of dividends. It's weighted by total dividends paid, not dividend yield. And that is only down by 2.26%. I say only because it is less than other global options as a consequence of that dividend weighting. We then have UC99. This is down by a massive 5.35%. If we click into this one, another quality factor ETF, but it includes US companies that are considered to have high quality characteristics. Now, this isn't a sector neutral index, so what that means is it can overweight sectors that have more higher quality companies in them. And because the tech sector has a lot of high quality companies in it, it does overweight the tech sector. And what that means is in months like this, when the tech sector has done quite poorly, it will of course go down. And then up next, we have an emerging markets ETF, EMIM. So MSCI Emerging Markets IMI gives you exposure to large, mid, and small cap stocks in emerging markets. It's market cap weighted. The total expense ratio is 0.18%, and it's a very large fund from iShares. Scrolling down, largest companies, Taiwan Semiconductor Manufacturing, Tencent, HDFC Bank, and so on. Then lastly, we have a small cap ETF, the S&P Small Cap 600. This one gives exposure to small cap companies in the United States. It has a total expense ratio of 0.3%, so small cap ETFs do tend to be more expensive. And we can look at the breakdown, but because it is small caps, you're unlikely to have heard of any of these companies. And looking at the performance of this ETF, small caps have had a very rough month, and this is typical. Small caps do tend to be more volatile than large caps, so when you have a negative month, they do tend to be hit harder. Not always, but generally. We scroll up now, we can now switch to the maximum view to see how all the ETFs have been doing. So to put things into context, as usual, I've held all these ETFs since November 2023, apart from UC99, which I first added to the portfolio in February 2024. So XDEQ is up by 27.81%. That's the best performing ETF in the portfolio at the moment. And this is a time-weighted rate of return. GGRG up by 22% since I added to the portfolio, time-weighted return. UC99 10%, emerging markets 14%, and small caps 18.2%. So we've seen some significant swings, especially with UC99 and ISP6, with them having a pretty poor month. And then I'll just quickly dive into the analytics to share this. We can see the region breakdown, 64.6% North America. Now, the analytics is one of my favorite features of InvestEngine. It's great to see the breakdown and how much you have in pound terms in each region, but more importantly, and more interesting to me, in each stock. So it's great to see as an ETF investor what I actually have indirectly in each company through my ETFs. So I have Microsoft, £1,200, Apple, 1,087, Nvidia, 800, and so on. It's really cool to see how much I have indirectly in each company. I really do enjoy this part of InvestEngine. Jumping into the SIP here, you can see now portfolio balance is up massively. It's nearly 10K now, and that is due to further contributions on my part. Looking at the performance on the maximum view, you might be a bit confused here. How come it can be minus £15 but up 17%? Well, this is because of time-weighted rate of return, and I have made the significant contributions in this portfolio in the last few months. You can see here, I opened the SIP over a year ago, but I only put £100 in. And the market, of course, has gone up since that £100. So the time-weighted return is positive, but because I have put a lot of money in the last few months and the market's gone down, that's why the overall return is negative. Switching over to the past month, we can see it's down by 3.44%. Or £244. This is not distorted, it's a bit simple to understand here. I am down by nearly £250 over the past month with the market movements. And then to go through the transactions, these white dots here, I put £100 in on the 5th of February, so that was the savings plan I had set up. The 25th of February, I had £1,120 go in. This was the tax relief from my earlier contributions arriving. So my contributions in December, I got the tax relief for, and I just invested that money straight away. And then the following day, there was a bit of spare change from that transaction. I just invested that as well. And then on the 27th of February, I made a significant contribution of £4,000 into my SIP. Basically, what I've done here is I've decided rather than maxing out my ISA this tax year, it'd be better for me to put this money into my pension, get that tax relief, and reduce my self-assessment tax bill by increasing my basic rate band with this pension contribution. And then 28th of February, you can see £8 went in there. And again, I think that's just a bit of change left over from the previous investment. So scrolling down now, my SIP is super simple. It's ACWI, which is a global index fund. If we click on this one, it's by State Street. It has a total expense ratio of 0.12%. So it is currently the cheapest global market cap weighted ETF available on InvestEngine, and it gives exposure to developed and emerging markets. So what you got to be careful with when picking global funds, some of them might have world or global in the name, but they're only tracking developed markets. Whereas this one is definitely a global fund developed and emerging at market cap weight. That is down by £200 over the past month, or minus 3%. So you can really see how the global market has performed. Not a good month for the markets. But as a long-term investor, it's really not something I even give a second thought. And you might be thinking with that significant contribution, I was trying to time the market. That is not the case at all. I had that planned anyway. I was going to put that £4,000 in regardless of what the market was doing. It's just quite lucky really that the market had that dip when I put that contribution in. What I always like to say on this channel though is when people say they buy the dip, just be careful. The dip can always dip further. Timing the market is incredibly difficult. I just consistently contribute regardless. When I have a significant lump sum to put in, I just put it in. Don't try and time the market, because when people try and buy the dip, you can get stung. The dip just keeps on dipping, and then you get FOMO and you think you could have timed it better. The answer is you probably couldn't have timed it better, because no one can time the market perfectly. Don't beat yourself up, automate investing, make it simple, and you probably do okay over the long term. Okay, and then the other ETF in the portfolio is RTWP. This is 10% of the portfolio, a bit of an active play by me, you could say. It is still a passive fund, but it tracks US small cap. And I put a bit in because they are quite relatively cheap from a valuation perspective, but as you can see here, over the past month, they've taken an absolute beating. They're more volatile, as I said, with the S&P 600 ETF. Russell 2000 and S&P 600 are very similar. And in fact, this ETF, despite the fact it doesn't say it in the name, tracks the Russell 2000 with a quality filter. In practice, the Russell 2000 with a quality filter is very similar to the S&P 600. Total expense ratio of this one is 0.3%. Again, small cap ETFs do tend to be more expensive. I went with an accumulating ETF in this SIP because, again, I just want to make it super simple. Don't even want to think about reinvesting dividends. It's all just happening in the background. The only change I can see myself making with this SIP is in this 10%. The other 90% I'm not going to touch. Global fund, super passive, just have it ticking away. I can't access this for 30 plus years anyway. I don't see the point of thinking too much about it. But that's just my strategy. What's suitable for me may not be suitable for you. I just like this passive hands-off approach. So that is it for this portfolio update. As you can see, I've not panicked. I've not tried to time the market. Yes, I've had a significant contribution. That's just coincidental. Always remember that when investing, you should expect volatility. It's part and parcel of investing, and negative months no longer even make me flinch. I just keep on investing, and although I do check every day, it doesn't bother me. But if you're the sort of person who panics over seeing red numbers, then it may be worth looking into automating your investing and just not looking at it, having it ticking away in the background over the long term. One discussion point I did want to bring up was how I mentioned in a recent video on the Vanguard ETFs, the fee war, all these global funds launching or having their fee cut, competing, and we're having a bit of a fee war in the ETF space. I am looking to see if these factor funds are going to have their total expense ratios cut, because the problem with investing in factor ETFs is that if they become so much more expensive than a standard market cap weighted ETF, it kind of becomes a bit pointless, because even if they deliver a small premium over the market in the long term, there's no guarantees. But if they did, the big fee difference might take away any of that premium anyway. So I am going to be keeping an eye on them. I'm hoping to see some fee cuts in the ETF space more generally. But if it gets to the point where there's like a 0.2 percentage point difference between a factor ETF and a standard market cap weighted ETF, I'm going to start struggling to justify the use of these factor ETFs. It's just something I'll be keeping an eye on. If you enjoyed this video, please consider leaving a like and subscribing for more investing content. Let me know your thoughts in the comments below, how your portfolios are doing, and as always, thank you for watching.